All right, let's get right into it. For years, I was completely obsessed with picking individual stocks. I mean, who wouldn't be? You hear these incredible stories about someone turning a few $1,000s into a fortune overnight by betting on the next big tech company or a groundbreaking biotech firm. The media loves these stories. They splash them all over the headlines, making it seem like finding the next Amazon or Tesla is not only possible, but something you should be actively trying to do. It's presented as the ultimate financial game, a high-stakes chess match where the smartest players walk away with life-changing money. The allure is powerful, almost intoxicating. The dream they sell you is one of financial genius. You imagine yourself poring over charts, finding that one hidden gem that all the Wall Street analysts somehow missed. You picture yourself telling your friends, "I told you so," as the stock you picked skyrockets to the moon. This narrative is incredibly compelling because it taps into our desire to be smarter, to have an edge, and to achieve extraordinary results through our own intellect and daring. It's not just about the money. It's about the validation that comes with making a brilliant call that nobody else saw. It's a powerful fantasy, and for a long time, I was completely hooked on it. This idea is reinforced everywhere you look. You see YouTubers and financial gurus flashing their massive gains from a single stock pick, making it seem like a repeatable strategy. They talk about their DD or due diligence, as if it's a magical formula for uncovering guaranteed winners. Let me tell you, it's incredibly easy to get swept up in that hype. You start to believe that you too can decode the market's secrets. You think that with just enough research, just enough late-night reading of financial reports, you can pinpoint the exact moment to buy and sell for maximum profit. The entire culture around stock picking is built on this exciting, fast-paced promise of a jackpot. So I dove in headfirst, convinced I was on the path to becoming one of those stock market legends. I believed that passive investing was for people who didn't want to put in the work. I thought I could outsmart the system. I was ready to analyze earnings reports, follow CEO interviews, and track every bit of market news to gain my competitive advantage. The goal wasn't just to make money, it was to prove that I could beat the market at its own game. Looking back, it's clear how much of this was driven by ego and the thrill of the chase rather than a sound, logical investment strategy. It all started when I was younger, saving up every dollar I could. I was fascinated by the concept of making money work for me. The stock market seemed like the most direct way to do that. So I opened my first brokerage account, funded it with a bit of cash I had painstakingly saved, and felt an immediate rush of excitement. I spent weeks, maybe even months, researching. I read books, watched videos, and followed every market commentator I could find. My first pick was a company that I thought was revolutionary. I understood their product, I believed in their mission, and I was convinced they were undervalued by the market. I remember placing that first buy order. My heart was pounding as I clicked the button. It felt like I had just unlocked a new level in the game of life. For the first few days, I was glued to my phone, refreshing the stock price every few minutes. When it went up by a few percent, I felt like a genius. I was already calculating my potential future profits and envisioning myself as a stock-picking prodigy. The initial success was a powerful drug. It confirmed my bias that I had made the right choice, that my research had paid off, and that this was going to be easier than everyone said. This early win propelled me to invest in more individual companies. I started looking for my next big hit. I'd scan financial news for hours, searching for whispers of a potential breakout. I bought into a popular tech company, a retail brand I liked, and even a more speculative energy firm based on a tip I read online. Each purchase came with the same cocktail of emotions, a mix of hope, anxiety, and the thrill of taking a calculated risk. My portfolio became a collection of stories, companies I believed in, companies I thought were undervalued, and some that were just pure gambles. I was no longer just a saver, I was an investor, an active participant in the capitalist machine. The problem was, my strategy was based more on narrative and emotion than on solid, diversified principles. I was chasing the excitement. I found myself drawn to companies with big, dramatic stories rather than businesses with boring, predictable cash flow. It's easy to fall in love with a company's vision and forget to scrutinize its balance sheet. I was essentially building a portfolio of lottery tickets, each one representing a hope for explosive growth. In the beginning, when the market was going up, this felt like a winning strategy. But I was unknowingly setting myself up for a very stressful and bumpy ride. Let me be clear. Picking stocks is incredibly stressful. It's a full-time job that you don't get paid for, unless you get lucky. My day started and ended with the stock market. I'd wake up early to check pre-market trading. and my mood for the entire day would be set by whether my portfolio was green or red. A good day meant I was brilliant and on top of the world. A bad day, however, meant I was filled with anxiety and self-doubt, questioning every single decision I had made. This emotional roller coaster is absolutely exhausting and takes a massive toll on your mental well-being over time. The need to stay constantly informed is overwhelming. You feel like you have to read every news article, every earnings report, and every analyst upgrade or downgrade for the companies you own. A CEO sneezes the wrong way, and the stock could drop 10%. A competitor launches a new product, and your investment is suddenly at risk. You're constantly living in a state of high alert, trying to anticipate events you have absolutely no control over. I remember losing sleep over rumors of a supply chain issue for one of my companies or stressing about an upcoming Federal Reserve meeting. It was a relentless cycle of worry. Then there's the psychological trap of what if. You sell a stock and it immediately shoots up 50%. The regret is crushing, or you hold on to a losing stock hoping it will recover, only to watch it sink lower and lower. This is called loss aversion, and it's a powerful bias that causes investors to make irrational decisions. I made this mistake multiple times. I held on to losers for far too long, anchored to my original purchase price, unable to accept that I had made a bad call. Meanwhile, I would sell my winners too early to lock in a small profit, missing out on much larger potential gains. The feeling of missing out, or FOMO, is another major challenge. You see a meme stock going parabolic on social media, and you feel an intense pressure to jump in before you miss the ride. This often leads to buying at the peak, right before the inevitable crash. The whole process turns into an emotional mess. You're not investing based on fundamentals anymore. You're reacting to market noise, hype, and your own internal fears and greed. My decision-making became compromised, and my results started to reflect that. The initial excitement had faded, replaced by a constant low-grade anxiety about my money. My turning point wasn't a single dramatic event. It was more like a slow, painful realization that what I was doing just wasn't working. It was the culmination of countless hours of stress, a few significant losses, and one particularly humbling experience. I had invested a decent amount of money into a company that I was absolutely certain was the next big thing. I had done more research on this one stock than any other. I understood their technology, I read their patents, and I listened to every investor call. I was all in emotionally and financially. For a while, it did well, and my confidence soared. I felt like I had finally cracked the code. Then, one morning, the company released a quarterly earnings report that missed analyst expectations by a tiny margin. It wasn't a disaster, but the market reacted viciously. The stock plummeted over 30% in a single day. I watched in disbelief as a significant chunk of my investment evaporated in a matter of hours. All my hard work, all my research felt completely worthless. The market didn't care about my brilliant thesis. It reacted to one data point and punished the stock mercilessly. That day was a brutal wake-up call. I realized that even if you do everything right, the research, the analysis, the deep dive, you can still be catastrophically wrong. There are just too many variables outside of your control. You can't predict a sudden change in consumer sentiment, a new government regulation, or a negative tweet from an influential figure. You are betting against thousands of the world's smartest analysts and powerful institutional investors who have access to more information and resources than you ever will. The game felt rigged, and I was just a small player getting tossed around by the waves. The stress from that loss lingered for weeks. I finally had to ask myself a hard question. Is this worth it? Is the potential for outsized gains worth the constant anxiety, the emotional turmoil, and the very real risk of significant losses? I was spending so much of my time and mental energy trying to beat the market, and my results were, frankly, mediocre at best. That was the moment I decided there had to be a better, more sustainable way to build wealth. I needed a strategy that would let me sleep at night and wouldn't depend on my ability to predict the unpredictable future. With my stock picking ego bruised and my bank account a little lighter, I started searching for an alternative. I went back to the basics, reading books from legendary investors like John C. Bogle, the founder of Vanguard. His philosophy was the complete opposite of what I had been doing. He argued that trying to beat the market is a loser's game for the vast majority of people. Instead of picking individual stocks, he championed the idea of simply buying the entire market through a low-cost index fund. At first, the idea sounded incredibly boring to me. Where was the excitement? Where was the thrill of the hunt? But the more I read, the more it made perfect sense. An index fund, like one that tracks the S&P 500, holds small pieces of the 500 largest companies in the United States. By buying a single share of this fund, you are instantly diversified across the entire market. You own a piece of Apple and Microsoft, Amazon, and hundreds of other companies. You are no longer betting on a single horse to win the race. You are betting on the entire American economy to continue growing over the long term, which has historically been a very good bet. The key facts were overwhelmingly convincing. Studies have consistently shown that over long periods, the vast majority of professional, actively managed funds fail to outperform their benchmark index. These are people who get paid millions of dollars to pick stocks full time, and even they can't reliably beat the market average. So what made me think that I, with my limited time and resources, could succeed where they failed? The data was clear. The most reliable path to building wealth for the average investor was to accept the market's return, minimize costs, and stay invested for the long haul. So I made the switch. I sold off my remaining individual stock positions, accepting both the wins and the losses. It was a surprisingly liberating experience. I took all of that capital and invested it into a few simple, low-cost index funds. One for the US market, one for international markets, and one for bonds to add a little stability. My entire investment strategy, which used to be a complex web of individual bets, was now simplified down to just 3 funds. It felt anticlimactic, almost too easy. But for the first time in years, I felt a sense of peace about my investments. Let's break down the difference in the simplest terms. Think of stock picking like trying to find a needle in a haystack. The needle is that one stock that will generate massive returns. The haystack is the entire market of thousands of companies. Finding that needle is incredibly difficult, time-consuming, and there's a very high chance you'll never find it. In fact, you're more likely to get pricked by a lot of sharp, painful failures along the way. You might hear stories of people who found the needle, but you rarely hear from the thousands who spent years searching and came up empty-handed. This approach is high risk, high stress, and requires constant attention. On the other hand, investing in an index fund is like buying the entire haystack. By doing so, you are guaranteed to own the needle, along with every other piece of hay. You won't get the explosive return of finding just the needle, but you also won't suffer the devastating loss of betting on the wrong company. Your return will simply be the average return of the entire haystack, or the market. Over time, the market as a whole tends to go up, driven by innovation, population growth, and economic progress. This approach is diversified, low cost, and requires almost no effort. The costs are another huge factor. When you're actively buying and selling individual stocks, you're racking up trading fees. More importantly, you're creating taxable events every time you sell for a profit, which can eat into your returns. Index funds, especially ETFs, are incredibly tax efficient and have ultra-low expense ratios. We're talking fees as low as 0.03% per year. That means for every $10,000 you have invested, you're only paying $3 in fees. Compare that to actively managed funds that can charge 1% or more, which sounds small but can cost you tens or even hundreds of thousands of dollars in lost returns over your lifetime. The biggest difference for me was the emotional component. Stock picking is a game of emotion. You're constantly fighting fear, greed, and the urge to react to every news headline. Index fund investing removes emotion from the equation almost entirely. Since you own everything, you no longer care if one specific company has a bad quarter. Your success is tied to the overall economy, not the fate of a single CEO or product launch. You set up automatic investments. You don't look at it every day, and you let the power of compounding and broad market growth do the heavy lifting for you over decades. So, what happened after I made the switch? The results have been, in a word, fantastic. And I'm not just talking about the numbers in my account, although those have been great. The most significant improvement has been to my quality of life. I no longer waste hours every week stressing about the market. I don't feel my stomach drop when I see a negative news headline about a particular company. I've reclaimed so much mental energy that I can now focus on things that I actually enjoy and can control, like growing my business, creating content, and spending time with people I care about. The crazy part is that my investment returns have actually improved. By trying to be clever and pick winners, I was in reality underperforming the market. My few big wins were often canceled out by my many small to medium-sized losses and poor emotional decisions. By simply buying and holding broad market index funds, I am now capturing the full steady return of the market. My portfolio grows quietly and consistently in the background without any intervention from me. It's the ultimate set it and forget it strategy, and it works beautifully. The peace of mind that comes with this approach is priceless. I now have complete confidence in my long-term financial plan. I know that by consistently investing in diversified low-cost index funds, I am on a proven path to financial independence. I don't need to get lucky. I don't need to be a stock market genius. I just need to be patient and disciplined. This shift has fundamentally changed my relationship with money from one of anxiety and speculation to one of calm and confidence. It's a much healthier and more sustainable way to live and build wealth. If my story resonates with you at all, if you're feeling the stress and anxiety of trying to pick the right stocks, I encourage you to explore this simpler path. It might not be as glamorous as betting on the next big thing, but it's a strategy that has stood the test of time and is backed by decades of data. Building wealth should support your life, not consume it. And if you want to learn more about how to set up a simple, effective investment portfolio and other smart money tips, make sure to subscribe so you don't miss out on future insights.